Hello everyone and welcome to this first panel of the Digital Asset Sidebar. I have to say that this is actually a very good turnout given that this panel takes place immediately post-launch. So kudos on maintaining the momentum through DAS. I am delighted to be spending the upcoming 30 minutes talking to Kasper, Head of Tokenization and Crypto Infrastructure, Crypto Finance, part of the Deutsche Börse Group. Johannes Kaske, Product Owner for Digital Asset Custody at Ripple-owned Metaco. And Yves Holenstein, Head of Custody and Staking at Bitcoin Suisse. A trio of heavyweights, all seasoned product professionals in the crypto Web3 space. We are going to take a closer look at staking implementations as the most obvious, crucial, and highly demanded feature and capability following custody implementations. What are some of the considerations that staking product PMs should take, what they should be mindful about, some of the pitfalls to avoid, how can they launch staking quicker into the market? I am Artiona Bogo at Figment. I lead our technical integrations team, looking to work very closely with our custodian partners, exchanges, marketplaces, looking to build seamlessly and effortlessly the staking rails to Figment so that they can offer a robust staking product to their end clients and users and reap the staking rewards, right? So let's kick it off perhaps with you, Kasper. I spent a lot of time talking to staking and custody PMs, and they all wish they were live with staking yesterday. Crypto Finance launched your staking product last summer, and you leveraged some of our APIs to actually build the staking product. If you could walk us through your experiences, the learnings, your strategy for launching swiftly to the market, I think that would be really good insights for the audience here today.
Thank you, Artiona. And let me first thank you for inviting us here. I really feel like a movie star in this setting. But yes, correct. We went live last year, and because we are a regulated institution, part of Deutsche Börse Group, for us, speed is obviously important because we want to make money, revenues, etc. It's important. But what's even more important for us is to get it right, because we're on the institutional side, and on the one hand, we have our clients, so banks, asset managers who do a lot of due diligence on us. And on the other side, we have the regulator. And so when we roll something out, we need to make sure that if they look through, that they're really comfortable with the setup we have and that we have a very good control of all the risks that are involved with staking. And everyone knows about slashing risk, which is very top of mind. But actually, as an institution, when you look at staking, a lot of things, there's a lot of risks that you need to cover. Because it obviously starts with the asset that you have in custody. You need to get it onto a node and so on. You need to have it there for a while. You have network risks. You have validator risks. You have man-in-the-middle attacks. There's a lot to cover. And so for us, it's really important that we understand all the risks. And then we look at how can we mitigate some of them? How can we eliminate some of them? And what do we do with the residual risk? Who is bearing that risk? Because ultimately that's what the client will care about, and that's what the regulator will ask us as well. And to give you some very concrete examples, like we were very uncomfortable launching ETH staking pre-merge. We had some validators running in-house, but if you can't unstake an asset, that's a no-go from an institutional perspective because you can't really end the relationship with the provider. So that's something we had to wait for. And then with Ethereum, you're actually sending the assets out. So what was really important for us is to make sure when we transfer the ETH out, that there's no man-in-the-middle attack that we send it potentially to the wrong contract and lose the assets. And so that's why we've done a technical integration with a lot of validation to make sure that we have zero man-in-the-middle attack vectors, which took quite some time, something we had to engineer from the ground up. But some of the risk is still there. Like there is still risk of downtime penalties. There is still some residual slashing risk. And so you need to understand that really well and then also make sure that the investors understand that. So that took quite some time to analyze that. And also from the regulator, they're also asking good questions. Like I actually received the questionnaire from FINMA, so the Swiss regulator, a couple of weeks ago, and they asked me, what are you doing about supermajority slashing risk, and how do you approach that? And I was like, whoa, these guys are really on top of their game, and they're not like a couple of years ago trying to learn. They're really deep into the topic, and you need to have answers to all these things. And again, that's where I already had my answer ready, because we already talked about it, but then we already have an approach for it. But these are things you really need to master. And so you need to have a lot of expertise to enter staking on the institutional side. So those were a lot of things we had to look at. Also, nowadays they ask you, where is your living will? What if you go under? Please tell us for each currency how you are planning to unstake the assets if you're no longer there. How can we get them back? How can we get them back to investors? So all those things you really need to figure out. And then crypto finance has historically built everything in-house. So we have our own key management solution that we built, which stores a couple billion worth of assets. So all of these things were engineered from the ground up. We run our own nodes. We had some validators pre-merged, so we knew how to do it. But then we were really looking at, are we build this or will we buy this? And it's not like days where there are no good providers anymore for a lot of the things, and you need to build it yourself. So we decided to have a look into the market. And we realized that there are really good providers out there. So we decided to actually focus on our core, which is keeping assets safe, then partner up with a staking provider, because staking provider has to cover a lot of things. Like you need to know all the protocols. Staking on each protocol works slightly different. So you need to build up all that knowledge in-house. And also, I think staking is still very early on. We will talk about EigenLayer later, but there's a lot of innovative things happening, and you really need to keep up with all of that. And it's quite cumbersome if you need to manage all of that yourself. So that's why we decided to partner up. And also, it's been great because Figment also helps a lot, for instance, when we talk to FINMA to explain how they mitigate risks on their side. So you really have to cover all these things. So
some really good points, Kasper, and thank you for bringing up and sharing all of these insights. And I actually have to acknowledge that we loved working with you guys, and we added the Figment signature as part of the response of the provisioning API to ensure that there are not any man-in-the-middle attacks, and to increase the security posture and comply with your requirements. So it has actually been a two-sided collaboration where we actually also enhanced some of our offerings. So thank you for that, and all great points. I think there was a lot to unpack there. So leaving it with the audience. Thank you, and wonderful. Johannes, moving on to you. While crypto finance did this fully automated API-based implementation, we've seen some of other custody solutions actually rely on Wallet Connect or similar offerings that allow connectivity to dApps and then allow staking from those dApps that are coming from third parties and so on. And this admittedly has improved time to launch, right? Go to market. So how do you see this? How do you make decisions like a manual-based staking approach versus fully automated and more scalable, long-term, bulletproof solution, if you will? How does this reflect in your clients' requirements and needs, so to say?
Thank you for the question. So first of all, we at Metaco are in a slightly different positioning than you guys, as we are the sole tech provider to our clients, which do intend to offer regulated services to their clients. And due to the fact that you just mentioned that direct staking approach is too much of a hot thing for many of our clients. So what they're trying to look at from a security point of view, from a governance point of view, but also from an operational point of view, is to segregate duties and to look really for specialized providers when it comes to actual staking part, i.e. managing the nodes, managing the beacon chain, indexing the beacon chain, understanding the reward structure, understanding the reconciliation and the kind of stuff. And for that, Wallet Connect as an open source protocol is a way to basically do a cryptographic handshake from a security point of view. So basically a custody solution that is focused on providing security around signing transactions on the blockchain. That's what it can do, right? But as soon as leveraging Wallet Connect or dApps or liquid staking, it becomes sort of a black box from a control point of view, right? So you sign a transaction, it's executed on the execution layer of of the Ethereum blockchain. But then the node is set up on the beacon chain, it's indexed on the beacon chain, it's maintained, you have all those slashing risks, you have other risks, but that becomes pretty much a black box from a custody point of view, right? So Wallet Connect, while being this cryptographic handshake, there needs to be more. There needs to be the corresponding data, there needs to be reporting, there needs to be to understand what is happening on the beacon chain. Because at the end of the day, if you want to provide a regulated staking offering, you need to have the full picture of your assets, a reconciliation of the assets. What part is staked? What is my staking position, right? How fast can I exit that or enter that stake? I think from an operational point of view, the Wallet Connect feature would be sufficient for the operation per se, which is the custodial operation, because staking doesn't happen too often, like on a daily basis, right? So like the operational piece of it is fine, but the main problem is that you basically need to tap another data source to really reconcile your assets and have this full and compliant picture of your holdings. And that's what needs to be filled at the end of the day.
Precisely. This was a little plug that whereas Wallet Connect, can be considered as a low-hanging fruit for Ethereum staking because contract call data is visible and somewhat, you don't fall into the security considerations of doing any blind signing and all of that because you still can read contract call data. Long term, we want to go to fully automated solutions where you have more control and you can actually understand and fully, read what's going on and what you're signing and all of that. So, but you made some really good points on reporting. Kasper, you want?
Yeah, I can add like a couple of points as well. Like we always take from a segregated wallet, so rewards go directly into the segregated wallet, and we tie validators directly to an asset key that belongs to a client. So there it's also very good to be able to calculate per client how are the rewards coming in, because in the end you also have to set up your entire billing structure, which can get quite complicated depending on the protocol you're working with, because every protocol works a little bit different. And then also from an operations perspective, if you have to stake a large amount of ETH and you have to do it in batches of 32, it might become quite heavy to validate every batch. So that's also where we had some good implementations with splitter contracts to make sure you can stake a large batch very securely in one go and then have it automated from there on to spin up a lot of validators. So those are also some things which are very important if you want to create a staking operation, to make sure you have answers to those operational topics as well, because they can get quite cumbersome.
Yeah, it does depend on the use case, right? If you have your treasury manager looking to stake on a regular basis and do those clicks, I don't know, like once every 2 weeks or once a month or so, okay-ish to do that manually, right? But if you need a streamlined solution and you offer that as an end product to users, you actually don't want to have someone who's sitting behind the PC and clicking. You want to actually trigger that action automatically. So yeah, a consideration maybe for the staking PMs in the room here, to evaluate both approaches and probably.
To be clear, we still have a 4i check on every staking request, but it's kind of what comes after that.
Precisely. And Johannes, you did mention reporting, and this is actually a very good segue to what I wanted to ask Yves about. Obviously, reporting is a cornerstone capability of a robust and complete staking product. We've seen various data providers emerge in the past few months, and actually, helping staking providers to actually fill in some of the gaps, because indexing is hard. Not every staking provider does indexing in-house. How do you see this? Like, would you outsource rewards indexing capabilities to like a third party, or would you do this yourself? And I want to provide some little background here. Perhaps a lesser known issue would happen end of last year, beginning of this year. Rated gave us a shout out because there was a bug in the MEV rewards. Whenever there was a withdrawal, consensus layer withdrawal to the fee recipient of the same block, the MEV rewards were inflated, and so people got excited because they thought that they hit the jackpot and got a really huge MEV reward, which was wrongly reported by the Beacon Chain API. But this had huge consequences, because you ended up charging the client much higher, right? So it's like big red flag there. And so we sorted this out with Reddit, and Reddit actually put up like a blog post around it, and we then saw a bunch of other staking providers actually fixing this. So this is like a significant consideration, right? Especially for Ethereum, where indexing rewards is slightly more complicated. How do you do it at Bitcoin? How do you do it actually at Bitcoin Suisse? It's like, how do you weigh the decision of taking some of the indexing in-house versus outsourcing to third-party providers?
Yeah, so looking back on how we did it first, when we started with staking in 2018, there was no data providers. So we had to build everything from scratch. And we also run our own indexing nodes for all the blockchain protocols that we support staking for. That includes Ethereum, where we started also on Genesis block. And for our, let's say, clients staking with us, it's not that much of an issue. Also the topic with Reddit, because we basically collect the rewards on the addresses that are assigned to the validators, and we know exactly how much every client of ours from every address was staking in every epoch, and then it's a rather simple division. It gets a lot more complicated if you want to set that into relation with the whole network's performance. That's exactly when those topics come a lot more into play. And we just recently in December, we launched an index together with stocks on blue chip crypto assets. And let's assume we would launch an index on staking assets. You need very reliable data of the whole network's performance. And that's something where we definitely would go with a provider like Figment, for example, to get a reliable data feed and to know that the expertise is there to have reliable data and complete data.
Makes sense.
May I ask just a question from my end then? Would you say then that in-house indexing is essential just for the indexing part?
If we were to start from scratch, we wouldn't do it in-house. So we would start directly with seeking that data from a provider. I mean, in the end, it's a matter of what skills you have in-house and what the business case is, but I would try to buy before I would build.
Very quickly, like if we stay on the rated side of the story, like last year we had a lot of clients, or like even 2 years before last year as well, handpicking validators, doing one-to-one performance comparisons, which is like terribly wrong, right? And so we've gone a long way. We've educated the audiences and all of that. How do you talk about risk-adjusted rewards with clients? Like if you can be a little brief, as we actually have to wrap up. And how do you discuss some of the underlying decisions that a provider needs to do to actually ensure, optimize rewards, not just for a couple of months, but years, and the long-term risk-adjusted rewards that everyone wants, without being too excited about some high jackpot MEV rewards initially, but then getting slashed suddenly. So first of all, our client base is mainly crypto native, and most of them have been in the game for quite long, so they're quite savvy. Nevertheless, based on our history, it has not that much been a question, because we've been in the crypto space for 12 years. We did, however, as some people may know, have an event last year. And what we see now more, not only because of the event, but because of more regulation coming into play, auditors having tighter requirements, etc. We see that clients are reluctant to take over the residual risks, and they want to have more transparency on the risks. We, in our terms and conditions, have usually about 4 or 5 pages of just all the risks that are protocol specific and specific to the services we provide for the protocol. There has not yet been a lot of discussion about risk-adjusted rewards yet. However,
I think as soon as we have comparisons, we have standards, and there's, for example, Alluvial and Rated, together with Figment and some others, working on a standard. There's the DAC initiative of Lido, etc. So as soon as we have something that makes the risks more comparable, I think it will become an essential component of evaluating your staking provider.
Makes a lot of sense. Johannes, if you can be brief about the security considerations of actually launching staking products, and how do you bake in the offering some of the less visible factors that actually comprise a robust staking product, like starting with how the validator provider actually manages and operates the keys to the underlying software clients which are employed, and so on and so forth. I mean, we had a huge event with Nethermind early this year, which brought all of the attention to Geth, and rightfully so. How do you explain this to your clients, as this is obviously not visible at first sight, but it's an important factor of the overall product?
Yeah, absolutely. So we discussed basically the risk of direct engagement, or basically indexing yourself and doing direct staking. And here the recommendation is really to go for sort of best of breed strategy, and really to say, like, I'm going to have specialized providers for each part of the value chain. And the segregation of duties as well, right? So this is not only true for custody and staking, this is also for trading and settlement. We have this segregation of duties, we have it across basically the digital asset ecosystem at the end of the day. Now, when we discuss security aspects, obviously it's about the handshakes between the various components of a technology stack. It's basically operating custody with the utmost security, so having a proper governance framework with cryptographic proofs and security around the actual signing operations that happen on the execution layer. And that's basically where we position really the governance as the most important piece, as it's basically controlling who has the control over the asset, who is authorized to enter a stake, who's authorized to exit a stake, and who's authorized to receive basically rewards. But then when you integrate with those partners, there are a variety of other security aspects that you need to consider. It's man-in-the-middle attacks on the one hand. It's how to secure API keys that you use to authenticate against specialized service providers. How do you secure basically other authentication pieces or secrets that you use to basically engage with a custody platform, and basically this overall ecosystem. Basically, it's the handshake between the components that really makes a difference at the end.
Makes a lot of sense. Yeah, there are 360 degrees on the overall security aspects of the product. Kasper, last question, and let's be brief. We need to keep tabs with the time. There's no staking panel if I didn't ask you about eigenlayer restaking, but we also have, like, precisely right after this panel, like one which actually goes deeper into that, and we're very happy to have the founder of Eigenlabs with us today. But given that restaking does change the risk-reward profile, like, how do you explain this to clients? Like, how are you thinking about baking it in the end staking product? Basically, how are you thinking about eigenlayer restaking and baking it to the end product offering?
Yeah, so easy questions last, right? Okay. So, and we have the founder here, so I hope I do it justice, but it's still very early days for us. Eigenlayer, obviously, me personally, the first time I heard about it, I was like, this is a crazy idea. I'm not sure it makes sense. And then I read up quite a lot about it and started to understand it and played around with it a little bit, and then it started to click. And for two reasons.